All right, guys. So, yeah, we got the AFRM earnings. They got destroyed for these earnings. We also have Zillow coming out today. Let me put the after-hours scanners up so we can see what's moving in after hours here. But we also have the Zillow earnings call today. I think the AFRM earnings are going to be in about an hour. But we should have the Zillow earnings call that we might be able to listen to as well. If not, so let's check. Here's investor relations with Zillow. Let me see. Is it third quarter results? Yeah, it's going to be at 4 p.m. for Zillow too. So we still got about 45 minutes. But how are you guys doing today? Y'all doing good? What did y'all do? Hit the subscribe button if you haven't already. Hit the notification bell. Yeah, Ben. Yeah, man. AFRM, huge drop. We got Zillow too that we can pay attention to as well. But AFRM got absolutely hammered. My question is, are you buying the dip? If we look at the AFRM results, AFRM had an update. He said, due to human error, a small portion of Affirm's fiscal second quarter results were inadvertently tweeted from Affirm's social Twitter account earlier today. They have since issued their complete fiscal year 20 second quarter results. And so if you guys have another stock that the earnings call is a little bit earlier, I know this one doesn't start for about 55 minutes. If y'all have another earnings call you would prefer to listen to while we hang out here, I checked Zillow. Zillow also has earnings dropping today, but I don't believe the call is going to be again until about 5 or until about 4 p.m. or 5 p.m. market time. So here's Zillow right here if you want to check out Zillow. Zillow, I believe, had some good numbers that dropped just now for Zillow. So Zillow, I'm pretty sure had some good numbers that dropped. Let me see. Yeah, so the conference call for Zillow is scheduled for 5 p.m. They reported fourth quarter fiscal year 2000 results for Zillow. Let me see what they are. Grab earnings. What's up, Ali B? Yeah, man. To be honest, the fact that how's the music level? It's not too loud, huh? Since we're not doing an over, I turned it up a little bit. Let me know if that's too loud. Since we're not doing an earnings call currently, we can turn the music up a little bit. But yeah, so I'm looking at these numbers here. We're looking at the AFRM numbers. I'm looking at this tweet. AFRM on the left side here. The tweet. Let me look at this tweet. This notorious tweet. If it even lets me, I'm curious if it's gonna let me. Oh, dude. Okay, there you go, my man. My man put in. Okay, so Affirm. Affirm posted a tweet earlier that said, another great quarter is in the books as we accelerated our growth, leveraging our superior technology and putting people first equals increasing the total number of transactions by 218%, active consumers by 150%, GMV by 115%, and revenue by 77%. He said, meanwhile, there was a large AFRM put flow before the halts, according to Unusual Whales. Interesting here. So here's Zillow running a little bit in after hours here. I'm trying to look up what the catalyst is. They're not going to tell us what. Oh, wait. So, okay, so we did drop Affirm. Affirm dropped second quarter loss per share. 57 cents versus 38-cent loss a year ago. So these are numbers dropping for Affirm. Let me see if we can find the actual. Yeah, okay, so we do have some numbers by Affirm. These are the numbers. I guess they already were reported, but the earnings were leaked ahead of the time. Here's the numbers right here. Affirm Holdings had a second quarter sales of 361 million, which beat the 328.8 million estimate. I might buy the dip in Affirm here. Do you think I should buy the dip? Let me know. I'm thinking about it. Also, guys, hit the subscribe button. If you haven't hit the subscribe button, hit the notification bell. I certainly appreciate it if you do. We do this live every day. We've been doing all the earnings releases. We did Disney yesterday. We're going to be doing whatever earnings releases are next week as well. Zillow breaking lows in pre-market. But yeah, hit the subscribe button. We do this live every single day for free, dropping the earnings call so you can hear them. We do have the numbers that are dropped right now. We're going to build up what Benzinga is showing us here. Here is the full Affirm second quarter results. So these are the full results we're about to post right here. They're going to be scrolling on the bottom. Almost done. We're just making sure we have the full list for you guys. There we go. All right, so I have the earnings release. We're dropping them in the chat right now. All right, so these are the numbers at the bottom. You see the numbers for Affirm scrolling through the bottom. You get Zillow making some volatile moves. Huge miss on EPS, but revenue beat halted down. Yeah, the second quarter results were not supposed to be released during market hours. They were supposed to be released today after the opening or after the closing bell, but somehow they got leaked early by their social media account is what I think I'm seeing here. And so with that, everybody got the news a little bit early. A lot of people are mad on Twitter. If you look at Twitter, everybody's upset because somehow these results were leaked a little bit too early and everybody's super pissed about it. So, you know, some people made out like bandits. I'm sure if you look at Unusual Whales made a post that's saying that if you look at the flow of options, some people bought put options before it happened. So there's some sketchy stuff going on there, but we'll see what happens with the firm. Yeah, I did buy Affirm at 54.62 during the plunge. That's a great entry. You're probably sitting pretty solid with that one. All right, so we got Zillow here. Zillow's at 50, 80, 51. Look at Zillow move here. I think I'm waiting for both the webcasts. They're both starting in about 50 minutes. So we're gonna hang out, talk about stocks, see what happens. But I'm waiting to see where we hear the conference call for Zillow. Okay, here we go. Found it. All right, so here's the report. Are they gonna have is Zillow gonna have a webcast? Okay, so I found it. So yeah, the Zillow one is not until 5 p.m. as well. So we're on hold for that one too. Starts at 5 p.m. Eastern Standard Time. So we're hanging out. Now let's check on the Affirm holdings. We are still waiting here. Yeah, let me check. Yep, still on hold with Affirm, which I believe it starts in 45 minutes. The webcast starts at 5 p.m. Eastern Standard Time. All right, so maybe we'll buy some options. What do you guys think? Can't believe the CFO blew this for Affirm. Yeah, it's tough, man. Bad results. It's cheap here, though. It is cheap. Let me see. My Robin. I don't see how much equity I have. Could buy, or I could look for some options here. Man, but how about AMC's craziness, man? What a ridiculous. All right, look at Zillow. Zillow's running. I don't suppose that they're going to drop the Zillow results early, no? All right, so Zillow did report some results. So we'll drop the Zillow results here. Zillow reported fourth quarter sales of 3.88 billion, which was better than the 2.78 billion estimate. So Zillow had good numbers. You can see Zillow running on the right side here. I'm trying to find a more up-to-date version of this. Let me see if we can find some more for Zillow. Yeah, they posted fourth quarter sales of 3.88 billion, better than the 2.78 billion estimate. That's all we're showing right now for Zillow, and they're running. This dropped about 7 minutes ago, and just to show you, 1, 2, 3, 4, 5, 6, 7. So once these numbers came out, Zillow popped all the way back up from about $49. It's up like $3 a share here. And again, hit the subscribe button. We live stream most of the major earnings releases, most of the major earnings calls. And so we are going to be having the entire earnings call streamed right here. You'll be able to listen to it, watch the chart as you listen to it, react, all that good stuff. And we do this for most of the major earnings. So hit the subscribe button. You know you want to. Yeah, Expedia. Yeah, I heard about Expedia, man. Look at Zillow testing highs up there. Expedia running. We can go ahead and look at what's going on there. All right, so Expedia's conference call is scheduled for 4:30. So we can do Expedia. Do y'all want to live stream the Expedia conference call? Because that we can start that, listen to that. And then, we might as well. I mean, here's EXPE, and it's running, and this is a legit big company, big stock. So would y'all prefer that? Hey, nice, Ali B. Okay, so we'll go ahead and stream the Expedia conference call. So save this so we don't have to. We got Zillow and AFRM. All right, so we're getting ready to stream the Expedia earnings call. I guess we'll start there. No, the AFRM earnings. I mean, they weren't bad, but they accidentally got released early, so that's the problem here. And we're gonna wait for the Affirm one. All right, so. All right, so. Expedia earnings. All right. They weren't bad. If you call losing 200 million over 26 million not bad. Is that really what happened? Let me see the Affirm numbers. The firm saw third quarter sales of 325 to 335 million versus 330 million estimate. Fiscal year 2022 sales of 1.29 billion to 1.31 billion versus 1.28 billion estimate. So higher than expected fiscal year 22 sales. They reported second quarter 22 active merchants increased from 8 to 168,000. They saw second quarter EPS, which is earnings per share, 57-cent per share loss, missed the 34-cent per share loss estimate. Second quarter sales of 361 million, which beat the analyst expectation as well. So where did they lose all that money? Where are you seeing that? Yeah, what's up, Kelly? PHUN offering. Yeah, EXPE ripping up too. The Expedia. Let me find the Expedia earnings call, and we can just listen to that while we're waiting here. Relations Expedia. There it is. All right. All right, so we're waiting on the earnings call for Expedia too. So we're on all these. You know? And again, if you like this, hit the subscribe button. All right, we got 211.39. So somebody asked me, hey John, why y'all just start? We streamed this morning too. I mean, we've been doing all the major earnings release streams. So Zillow ripping, yeah, Zillow flying here. It's up there to 56.11s here. Zillow is huge move, huge rip up. Zillow ripping, yeah. NET earnings. We can look at NET earnings too. Let me see. NET put in first quarter revenue of 205 to 206 million. That's the only thing I see. Let me see if we can find another source. Zinga. All right, so I saw, okay, Expedia put in fourth quarter EPS of $1.06, beat the 67-cent profit estimate. Sales of 2.28 billion, missed the 2.31 billion estimate. So we do have Expedia numbers as well here that just came out. Conference call is supposed to start at 4:30. The earnings did drop for Expedia though. We have Expedia Group at the bottom too, so we've got all the earnings. There's Zillow though. Zillow breaking highs. Affirm down there still. Come on. Hey, also guys, y'all hit the subscribe button if you haven't already. Hit the notification bell. We do this live every weekday morning for free right here. We don't sell a course. We don't sell a service. We don't claim to be experts. We don't charge a penny for anything, and we just give everything away for free. So speaking of free, if you want to try out Benzinga, you can try them out completely free for 2 weeks without even needing a credit card number. And I'm getting a lot of this information from Benzinga. Super useful, super helpful. And you can try them out completely free for 2 weeks without even needing a credit card number. So you want to try out Benzinga scanners, a great news resource. A lot of cool stuff on there. Here's the link. All right, guys. So what are y'all trading today? NET earnings. I see somebody asking me about NET earnings. So let's take a look at those as well. All I'm seeing is first quarter revenue at 205 to 206 million, or yeah, 205 to 206 mil is what I'm showing. All right, the Expedia earnings call is about to start in about 7 minutes. 7 minutes for Expedia. Let me check. Yep, still on hold. About 7 minutes. Zillow pulling back some. Affirm falling after hours, new low coming. I don't know, man. Affirm, they didn't have that bad of numbers. Not that I'm seeing. Unless I'm missing some big numbers here. What I'm seeing for Affirm is that they reported worse than expected second quarter EPS results. So their earnings per share were down. But anybody could see that. You know what I mean? The other numbers weren't bad. I mean, let's see. What was their EPS is okay, so their Affirm put out a few different things. Their guidance was actually the worst part, which is that they see more losses ahead, is what they said basically. Put in EPS of about negative 57 cents. So they're losing about 57 cents per share. They missed by 20 cents. So basically, they thought it was only going to be 37 cents per share loss. But instead, it was 57 cents per share. I think the worst part is their guidance, though, because their guidance means that their guidance was not good. They think the losses are going to continue. Yeah, for sure, AFRM. I trade GGP mostly due to the risk reward. Yeah, GGPI was ripping today. I saw that. All right, guys. Expedia Webcast coming. Let me. If we're gonna do the Expedia call first, we might as well. If we're gonna do the Expedia call first, we might as well switch the thumbnail to an Expedia thumbnail, right? EXP pulling back. We have the conference call for them coming pretty soon. All right, Expedia earnings call is going to be in 4 minutes. If you want to see the Expedia earnings again, you can look at the bottom of the screen. Expedia put in fourth quarter adjusted EPS of $1.06 profit, better than the 67-cent profit estimate. Sales of $2.28 billion, missed the $2.31 billion estimate. So Expedia came in a little bit worse than expected. Sales, but a higher earnings per share. And earnings per share is basically the gauge on how profitable the company is. And so I think EPS is more relevant than sales in terms of the health and growth of a company. And so with that, I think that Expedia, it's understandable why it ripped up. Now we'll see what happens, but we got the earnings call for Expedia in 4 minutes, guys. 4 minutes. And we're going to be streaming it live, like I said. Let me check. Oh, still on hold. Y'all can hear the music, huh? I just want to make sure y'all can hear this before the earnings call starts. Again, it's going to be in 3 minutes. That depends on what you get, Joshua. It depends on how you pay for it as well. All right, guys. Meet Paper Hands. Oh, that's me, Chris. I'm Big Papa Paper Hands, bro. If you expect me to be upset for calling me that, I'm gonna get a tattoo. It's gonna be BPH or BPPH. Big Papa Paper Hands. That's me. I'll put it this way. I do what makes me money, and so All right, guys, we got the conference call starting in 2 minutes. (4:30) is when the conference call starts. All right, so let me get the old list. CPI came out today and just tanked everything, but all right, guys, let's get ready. All right, so here's the conference call. It's supposed to start right now. See what they have to say. 1 minute, guys. All right, look at Expedia just tank here. All right, guys, so we're waiting. We got a minute. Still a minute. Gonna wait. Are you bullish on Expedia? Can't make profits if you don't sell. Yeah, I mean, I think it's kind of dumb. Like I said, I was bullish on AMC a few days ago. So I basically have been pretty correct with a lot of things. I don't think the culture of paper hands is a good. I think that you're supposed to cut losses, and I think teaching traders to be bag holders in terrible companies, and I'm not saying like I like some of these companies. I'm not targeting any specific company, but I know there's a lot of bag holders in penny stocks that have just gotten destroyed over the last year because people have been calling them paper hands. And so they just sit on these terrible companies for a long time, hoping that they'll come back, and a lot of them don't. So, I think anybody that calls somebody paper hands seriously and is actually mad at somebody or really is trying to insult them by calling them paper hands doesn't quite understand trading like you're supposed to.
And I will be the operator for today.
All right, so here we go.
If you wish to ask a question at the end of the presentation, please press star followed by 1 on your telephone keypad. If you change your mind, please press star followed by 2 to cancel your request. For opening remarks, I will turn the call over to IR Director John Charbonneau. Please go ahead.
Good afternoon, and welcome to Expedia Group's financial results conference call for the fourth quarter ended December 31st, 2021. I am pleased to be joined on the call today by our CEO.
Let me know how the volume is. Good? Can you hear everything?
The following discussion, including responses to your questions, reflects management's views as of today, February 10th, 2022 only. We do not undertake any obligation to update or revise this information. As always, some of the statements made on today's call are forward-looking, typically preceded by words such as we plan, we expect, we believe, we anticipate, we are optimistic or confident that, or similar statements. Please refer to today's earnings release and the company's filings with the SEC for information about factors which could cause our actual results to differ materially from these forward-looking statements. You will find reconciliations of non-GAAP measures to the most comparable GAAP measures discussed today in our earnings release, which is posted on the company's investor relations website at ir.expediagroup.com. And I encourage you to frequently visit our IR website for other important content. Unless otherwise stated, any references to cost of revenue, selling and marketing expense, general and administrative expense, and technology and content expense exclude stock-based compensation. And with that, let me turn the call over to Peter.
Thank you, John. Good afternoon.
Bullish or bearish on Expedia?
Joining us. Let me start off with a few broad comments about what we experienced in the fourth quarter, which I would say, even though we had to deal with a meaningful Omicron wave and a bunch of disruption in travel, and of course that was not great for travelers worldwide, it was encouraging in many ways. And I think what we observed most notably is that the issues that involved were really issues of inconvenience. There were border shutdowns. There were planes out of service because pilots and crew were sick, things of that nature. But there was far less consumer fear over traveling. And really, it was an issue of the inconvenience of the health issues. What we believe will come from this, presuming the next waves continue in an ever lightening way, is that the world has essentially gotten accustomed to the pandemic. It will enter perhaps an endemic stage.
Bearish bull.
And governments and industry, et cetera, will adapt much more easily as the next waves come. And in turn, this will continue to disrupt travel less and less. And certainly the consumers have remained willing to travel throughout. And with the return of staffs to the air and the relief of border issues, we are seeing a solid return to travel. Eric will take us through the numbers and the trends, but suffice it to say that we are pleased to see that bookings have strongly rebounded since anywhere that Omicron has topped out, and certainly we're seeing that broadly across our biggest markets. I've talked before about mix effects, and I won't belabor those except to say it continues to be real. Certain areas are doing better than other. Air is more challenged than other parts. Certain geos are more difficult than others. But in general, we feel good that big cities have not recovered as much yet, and that is a good guide for us. International travel is still yet to return as strongly. That is another good guide for us. So we feel like directionally that the things that will be coming back as COVID lightens generally benefit us, and we're looking forward to the days of those returns. With that said, I'm not really prone to doing retrospectives, but we are starting to focus much more on the future of our business and what we're going to deliver instead of how we manage COVID day to day. And I thought it would be useful for us to just reflect on where we've been and where we've taken the company over the last couple of years since we entered COVID. So first of all, the thing you have all observed and clearly have liked is that we've been able to simplify and make the business more efficient. And it's easy to observe and it's important. Obviously, there are more important things to our long-term future, but I'll spend a minute on simplification. We've been able to use, our push for new technology solutions, our push to reorganize the company in a more single goal fashion. We've optimized third-party spending and tools and many things, and we've become a much more efficient enterprise. In fact, today, and I should mention, as you know, we've also shut down or sold off certain businesses that we believed were non-core. As a result of that, we're running the company now with roughly 10,000 fewer people than we were at the end of 2019, which is a great credit to the people who are here, who have driven, a ton of hard work towards that goal of really running the company in a smarter, more efficient, better way. So that's been the big push there. And I would say that as we still face challenges of hiring people, we're like all the tech companies, but we have had a great influx of terrific talent. I think that momentum is increasing, and that mixed with the great talent we have has really put us in a great position as we move forward and as we start to move to really being focused on delivery of new tech, new experiences, and improving the traveler experience as our core fundamental goal. But as I say, efficiency is not the story here. Efficiency is a great thing we've been able to achieve. But the real story of our future is about what we're doing to drive the business forward. So just to break that into a few parts, on the demand front, guys, as you know, we've combined our multiple brands working in silos into one unified house of brands with a singular focus on driving travelers to the right product at the right time. This strategy is built on superior creative, making the brands make sense together, buying together in an efficient way, and of course, using performance marketing along with brand to really drive a more efficient way of bringing travelers into our universe. We believe we are well on our way to that journey. Hope you enjoy our Super Bowl ads in a few days. I think they're terrific. But it is a unified strategy that's about really delivering end-to-end a great demand generation strategy that is efficient and we believe can drive better outcomes in the future for us. We also believe, as you know, that loyalty will play an important role, and we are bringing our loyalty programs together, and that will begin to take shape over the course of the year, and I think pay dividends for years and years to come, and we're excited about that. On the technical front, this has really been the heart and soul of what we've been working on, which is getting to a singular platform so that we can drive a velocity of innovation for travelers and for our partners and really take travel to the next iteration for the online app-based travel business. We've been on this journey for a while. We've talked about how we're moving multiple stacks into a single stack. That's more than just a efficiency story or anything else. It's really about building it as a set of microservices with APIs that can be externalized and can more easily be used internally to drive these great outcomes for our travelers and our partners. And when I say travelers, I really mean all travelers, because for the first time, as we we build this out, we will be able to create innovation in our stack that impacts all our travelers, our B2C travelers, our B2B travelers, all in the same moment. So when we make an improvement in the checkout path, or we make an improvement in the app, all those benefits will inure to the traveler wherever they come from, and it will be able to drive real impact instead of the siloed way we used to have to work our way through it. So I think it's a really important step for both how we run our business, how much innovation and velocity we can bring to the travelers and partner experience, and frankly, just generally, how we innovate and drive the entire industry forward. We're really excited about what's coming. It's a big year of delivery for us, but there are amazing things coming, we think, for the traveler, from the discovery elements to the service elements and everything in between. And again, that will inure to the benefit of all travelers in our ecosystem. And finally, on the B2B side, which is really now an amalgamation of our B2B partners who drive demand and our partners who bring us supply, and more we see that as one universe. We've combined those teams into one group that essentially can have a 360 relationship with any partner, and therefore any partner can benefit not only from selling into our platform, but also taking services out of our platform. And we think that approach is going to be really powerful. We've kept very close to our partners over the pandemic. Obviously, we've had shared challenges and opportunities, and we've renewed a lot of deals across lodging, air, and car. And most of these deals have come with expanded capabilities where we've delivered more for our partners, and we believe help them drive their own businesses to better outcomes. We're excited about this partnership approach. It's no longer just about supply or just about can we drive demand. It's really about can we make our partners' businesses better, and we're keenly focused on that. So to close, I'll just say, you can never count COVID out. We've dealt with a fair number of body blows over the last couple of years, but the industry has proven resilient. I think demand has proven even more resilient, and we expect a significant rebound. And while we're excited to ride the rebound, the important thing for us is really delivery. We have to deliver on all the promises we've made about how we're going to improve the product, traveler experience, and how we're going to continue to run an efficient and effective business. And I would just say, ultimately, we believe in the reigniting of travel. We think we're going to play a central role in it. We're not.
Yeah, he sounds nervous.
Sit back and ride it. We want to be important in driving the future of the industry. And we believe we can bring benefit not only to travelers, not only to our own business, but to the entire travel ecosystem. And that is what we will be focused on this year. And with that, I'll turn it over to Eric.
Thanks, Peter.
All right, so he sounded a little bit nervous, to be honest. A little bit nervous, a little bit apprehensive. Their numbers already came out, though.
This year, and along with Peter, I'm excited to see us deliver more for travelers and partners. With that, I'd like to start by providing an update on booking trends. While we witnessed a notable pullback due to Omicron in December, which continued into January, I am encouraged by the improvement we have seen in recent weeks. Overall, in the fourth quarter, total gross bookings for all products, net of cancels, were down 25% versus Q4 of 2019. A slight sequential improvement versus third quarter. And when compared to 2019, we have continued to see a mix shift towards lodging, and more specifically, Vrbo versus air. Given the continued volatility of the recovery due to Omicron, again this quarter we are providing monthly detail on our total lodging bookings net of cancels, which includes hotel and Vrbo. For October, it was down 4% versus 2019. It was down 5% in November, 27% down in December, down 11% in January, with trends improving throughout January and with us up versus 2019 in the most recent weeks. From a geography perspective, this improvement has been driven by the U.S., followed by EMEA, while APAC and LATAM are lagging. Now on to the P&L. Total revenue was down 17% versus Q4 2019, roughly the same level of decline we saw last quarter. As a reminder, we closed the Egencia deal on November 1st. In the quarter, Egencia contributed $29 million in revenue. Note this does not include revenue tied to the 10-year lodging supply agreement, or EPS business entered into with GBT. Revenue margin for the fourth quarter was 13%, down from 16% last quarter, largely due to typical seasonality.
Yeah, you were right. NC
on sales and marketing, direct spend in Q4 was roughly $875 million, down 12% versus Q4 2019 levels, compared to 19% decline last quarter. As you know,
Q1 is a seasonal low point for EBITDA given the timing disconnect between higher marketing expense ahead of summer travel and lower stay and room nights in Q1. And this timing impact could be further amplified this year due to lower stays in Q1 due to Omicron and our spending into the recovery based on the recent improvements and trends we're observing. Moving on, overhead costs, excluding Agencia, in both periods, was up $23 million versus Q3 2021, primarily driven by the lower ability to capitalize labor in the fourth quarter. Looking ahead to this year, as we compete for great talent, we anticipate higher than normal annual compensation increases, which take effect on April 1st. In total, adjusted EBITDA was $479 million, up $1 million versus 2019 levels, despite revenue down 17%. This marked the third consecutive quarter of positive adjusted EBITDA and our highest Q4 EBITDA ever. And I believe the fourth quarter performance further illustrates how we are running a much more efficient business versus prior to the pandemic. On to free cash flow, which totaled roughly $142 million in Q4 on a reported basis. Excluding the change in restricted cash, which is primarily driven by the change in Vrbo's deferred merchant bookings, free cash flow was $35 million. Now shifting to the balance sheet. In 2021, our debt refinancing yielded approximately $80 million in annual interest expense savings, and paying off the full $1.2 billion in preferred stock last year saves us approximately $115 million in annual dividend payouts. More recently, we informed the holders of our 650 million euro bond last week of our intention to pay off the notes at the beginning of March, which is 3 months ahead of their maturity date. This allows us to save approximately $5 million in interest expense this year, or $19 million annually, while also improving our leverage ratios. Overall, we are pleased to have maintained our investment grade rating through the pandemic and remain committed to deleveraging while also looking for ways to further reduce our cost of capital. In closing, despite the continued impact of the pandemic in 2021, and most recently from Omicron, I am encouraged by the continued progress made last year to reshape the company and further improve our financial position going forward. As mentioned, I am optimistic about a travel recovery this year and excited to see how this year unfolds for the company. With that, Emily, we are ready for our first question.
Thank you, Eric. As a reminder, if you would like to ask a question, please do so now by pressing star followed by 1 on your telephone keypads. If you wish to withdraw your question from the queue, please press star followed by 2. When preparing to ask your question, please ensure that your device is unmuted locally. Our first question today comes from the line of Kevin Kopelman from Cohen and Company. Kevin, your line is open.
Thanks a lot. First, I wanted to ask about the loyalty program. Can you give us more details on when you expect to roll out the consolidated loyalty program, how that might change, and if you can give us a sense of how important your loyalty programs are today and maybe where they could go. Thanks.
Yeah, thanks, Kevin. Well, I'll say a couple things. First, this is an ongoing effort. As recently as this quarter, we just revamped our Expedia loyalty program to create a construct that we think is better for travelers and kind of directionally in where we're headed more broadly for a loyalty program. But there is a lot of migration going on. We're migrating the whole stack, as I talked about. We're migrating the brand front ends onto one set of rails, and we are rebuilding our loyalty platform to accommodate, one broad loyalty construct that can serve all the different brands. And so the big difference that's coming is really that the loyalty program will cover all our brands, all our products, and you'll be able to earn and burn across all of them, which is a great innovation. All the research shows that it's the most important thing to customers is having the breadth of products. And so we think it's going to be a great win for them. All the details are still being worked out of exactly how that policy and planning will work, although I think the Expedia construct is more or less in line with where we're headed in terms of how points work, et cetera. But it will take, the better part of this year to get all those pieces lined up. And of course, a rollout of the loyalty program, including converting loyalty people over from one to another.
Do you use Expedia chat?
And adding it to front ends that haven't had it and all those pieces. It's not just like you flip one switch, it's a switch after a switch after a switch. So I think, it will take us the better part of this year to be really have the product where we want it and be starting to convert everybody
This is
over to it.
Expedia, rockin' Rosie.
So I think next year will be the big impact year of the whole stickiness and totality of loyalty. But I think it's
Affirm
a big
is at
year for us as we build into it.
5
and
p.m.
hopefully we'll be
So
moving
20
some
minutes until
of
Affirm.
the program over to that in the course of this year.
Thanks, Peter. And if I could just ask about the latest trends, you noted that that lodging is now up in the last week versus 2019. Can you talk about how that might play out given cities haven't fully come back yet and international travel is still certainly not fully back given the restrictions are not up yet?
Yeah, sure. Well, I think, look, there's a lot of benefit in that for us in the sense that historically, big cities and international have been an area of strength for us relative to some of what we've seen during COVID, like domestic travel into tertiary markets, et cetera, which have been historically weak. On the other hand, we've benefited greatly. Virgo has been super strong. It's benefited from the leisure travel and the longer term travel of vacation rental and people liking that during COVID where they could isolate with their families, et cetera. So it's a little tricky to predict, but I would say broadly the stuff that's left to come in many ways favors our strongest areas. So I think that's positive. But, the mixes have been hard to predict over time. And so I don't want to get too much into prognosticating, but I think we've got some good runway ahead in where the puck is going. Mixed two metaphors there. And we feel good about that. You never know what the back end unintended consequences are, but I think being positive now with everything that's left to come is making us feel pretty good.
Great. Thanks so much.
Our next question today comes from the line of Naveed Khan from Truist Securities. Naveed, your line is open.
Great. Thank you. Two questions, please.
Yes.
Maybe just one on the comeback in travel as it continues to build in 22. How do you see the mix of direct versus paid traffic coming to your platform? Can you maybe just touch on the opportunities between the different levers that you have to pull between CRM versus branding versus performance channels? And then maybe just another word on capital allocation. So you continue to deleverage, and also you have kind of gotten the preferred out. How do you kind of see the scope for M&A opportunities here, and maybe other use of capital like share buyback? Just maybe talk about that a little bit.
Sure. I'll go first and deal with the comeback in travel. I think I'm glad you mentioned CRM. We have so much opportunity to improve our direct relationship with consumers. We've historically fished out of the big ponds of Google and Meta, et cetera, and brought customers in, and candidly not done a good enough job in retaining those customers and making it sticky and making sure the experience is good. We are keenly focused on bringing travelers in now, making sure they enjoy all the benefits of what we have to provide, member pricing, loyalty, et cetera, and that they get a better app experience, better CRM, which we are rebuilding like everything else. And we really focus on retaining them and keep them coming back as often as possible directly. It doesn't mean we don't expect to use performance marketing and all the usual channels, but we want to be able to derive much more long-term value from those customers we acquire and then in turn keep. So we hope very greatly that the denominator will be expanding. We'll just be bringing in more travelers, and that more and more of them we will be able to create direct relationships where they are coming back. They recognize the benefits we give them in price and service, and discovery, and everything else. Obviously, there's more to come there because as the products improve and the experience improves, it all gets easier, and that flywheel presumably turns faster. But that is our focus, and that is what we hope to derive from this. We're not projecting what percentage will be what, but it is very closely tied to all the work we are doing to drive the traveler experience.
And look at EXP go up.
The second part of the question around capital allocation. And I know we've talked about it in previous quarters, and I think our message remains the same. We are keenly focused on cleaning up our balance sheet, if you will, given the disruption that we've experienced over the last couple of years. That includes de-levering the business. We've talked about the preferreds that we paid off. We've talked about the Eurobond we're paying off, and we're going to continue down the path of de-levering, which of course can take the form of growth in the underlying EBITDA, but also in paying down debt as appropriate. Want to lower the cost of capital as well. In my prepared remarks, talked about a couple of areas where we have quite significantly reduced the cash flow required to service, whether it's the preferreds or different debt instruments. We're keenly focused on maintaining investment grade, and quite proud that we've been able to do that over the last couple of years, given the amount of disruption that we've had. And then a slight other lens on that as well is Peter's talking about the growth opportunities ahead of us and the opportunity for the company, and want to make sure that we are enabling that as best we can so that we can go as fast as we can in achieving that vision. Specifically on two components that you mentioned on M&A, we're always open for business. Even during the heart of COVID, we were open to business to a certain extent, but obviously that wasn't necessarily the right opportunity or the right time as things coming up. But we are looking at different opportunities opportunistically, and a few themes that we're thinking about. And then on buybacks, I think you can look at our long history. It's something that we have done regularly and consistently. I fully suspect that we will get back to that at the right time, and something that we will think about over the coming months. But again, we're going to observe COVID. We're going to clean up the balance sheet, if you will, and all the components that I talked about. That's where we're focused right now.
Yeah, and I would just add, just to close that one out, that on the M&A front, we're much more focused. It has to fit with our long-term strategy, our platform strategy. It has to integrate. Well, we're not going to be just buying things because they're good deals. We're going to buy things that fit our long-term strategy to drive where we're trying to drive.
All right, so EXP's been pushing up.
Thank you, Peter.
210 now, up to 210. So we'll see what we get. But they've been ripping up.
Our next question today comes from Eric Sheridan from Goldman Sachs. Eric, please go ahead.
Thanks so much for taking the question, and hope you're both well. Maybe just teasing out more on that capital allocation front, but bringing it back to margins. Peter, Eric, can you help frame for us? I know you've laid out before that you've exited sort of the efficiency program that you laid out from a couple of years ago, and there's obviously investments against your ambition you feel you need to make in 2022 and 2023 to capture some of that growth. But how should investors think about elements of where there is leverage driven by volume that can flow through the model over the next 12 to 24 months versus areas where you want to take incremental margin or incremental leverage and invest it back because you're playing sort of the long game over the next 3 to 5 years against the bigger travel opportunity? Just some of the variables that could flex margin leverage one way or another in the next 24 months. Thanks.
Man, dude, I got so many earnings calls up there. Stupid theme music is playing.
The way I think you should think about it is this. We have, as I mentioned, there's a lot of work still going on into building the platform to getting the platform right. When those things are right, they will drive further efficiency. So when you say we've exited the program, it wasn't like a program with a goal that we ended and said, we're finished. This is an ongoing drive for us to create the most efficient enterprise we can, which is not about taking people out. It's about being efficient in how we work, what we work on, how technology aids us, et cetera. There are lots of places where, for example, I'll give you one, service. We continue to build the best service technology, I believe, in the industry and scale it consistently. We are building skills across the enterprise so that customers can service their own issues themselves and easily. It's an ongoing process. But the benefit
of the efficiency
born of those improvements has not really been seen because COVID has had this enormously elevated service demand on the industry. So as we normalize out to historical propensities for service calls, et cetera, there is real benefit down the road in how we do that. Now, you alluded to there are places we are, quote, investing in. I mean, that is really just our way of saying we are pushing to drive this innovation and drive us across these bridges as quickly as we can. And if we need to invest more in people and resources to drive some of this innovation, we will do it. But the innovation in and of itself will drive incremental efficiency. So I don't think this is a long-term, this is a long-term sideways to down, expanding margin story, we believe, driven by the technical efficiencies that the product will drive. And if there's
AFRM
some bumps
starts
in the
in
road as we
2
get
minutes.
there, if we have to, flex up to drive an innovation faster, we may do that because we think it's the right thing for the traveler and for our partners. But overall, there's still much more opportunity to become more efficient over time for margins to expand, and we believe that's what we will continue to drive towards.
All right, so the AFM call,
Great, thank you.
we're gonna wait for the AFRM call. It's supposed to be starting in
Our
about
next
2
question
minutes
comes
now.
from the line of Lloyd Walmsley from UBS.
2 minutes.
Lloyd, please go ahead.
So we're just listening to the
Thanks. Two
Expedia
questions,
call while we're
if
waiting
I
for the
can.
Affirm
First,
call.
Any update on just the marketing integration, consolidating data and ops into a unified group? Like any early learnings there? And then secondly, can you kind of help us parse out the strong ADR growth? Like how much of that is a function of home away growing in the mix? And I guess more importantly, like what are the puts and takes of how you see ADRs migrating over the course of the year? Like, is this still a big tailwind because like for like channel pricing is going up, or does like a shift back to core hotel offset that? Like, how do we think about ADRs over the course of the year? Thanks.
Thanks, Lloyd.
All right, guys.
I'll take the first part.
Affirm call in 1 minute.
Watch the Verbo ad this weekend, so you start saying Verbo instead of home away. But on the marketing integration, we've made a lot of progress. In moving along on the marketing integration and the data and analytics and measurements, et cetera. I'd say we're virtually all the way there, not quite all the way there. And the learnings have been coming. Eric and I see reports weekly about where we're winning, where we're learning things, where we're testing things. There's no like silver bullet. They're like, oh, we found this and it's going to win everything. It's really a game of, 1,000
All right, guys, here's
different
the
little
Affirm
tests
call.
across 100 geos, across, 5 products.
Still hasn't started yet, so we're just kind of waiting for the Affirm call,
All
guys.
of it is incrementally getting there. We're feeling quite positive about a number of things we've been testing and learning. We're pushed heavily into mobile and other areas where we found opportunity. We're pushing into new products and social products and other things where we found opportunity that is, sort
Still
of
waiting for the
tantamount
Affirm
to
call.
performance marketing in certain ways. So there's a lot of interesting learnings going. The reality is, until things normalize, it's going to be really hard to measure us on this because you can't see what normal is anymore. And even for us, it's hard to see what normal is. And a lot of these new tests, new algorithms are learning on these very volatile traffic patterns, because of COVID, et cetera. So I think we feel good about the technical progress the teams are making, about the way they've plotted out their course of learning and testing. And there's no question it will inure to our benefit. But, being able to, identify a single
on
thing
hold,
or a
waiting
single
for the
win or
Affirm
have it
call.
quantified is really hard to do at this moment. So I think you're going to have to wait for the collective good to roll through our P&L.
Prevent any
All right,
background noise.
See it as things normal.
Following the speaker's remarks, we will open the lines for your questions.
All right, let me know how
As
that
a
sounds.
reminder, this conference call is being recorded, and a replay of the call will be available on your investor relations website for a reasonable period of time after the call. I'd now like to turn the call over to Ron Clark, Vice President of Investor Relations. Thank you. You may begin.
Thanks, operator. Before we begin, I'd like to remind everyone listening that today's call may contain forward-looking statements. These forward-looking statements are subject to numerous risks and uncertainties, including those set forth in our filings with the SEC, which are available on our investor relations website. Actual results may differ materially from any forward-looking statements we make today. These forward-looking statements speak only as of today, and the company does not assume any obligation or intent to update them except as required by law. In addition, today's call may include non-GAAP financial measures. These measures should be considered as a supplement to, but not as a substitute for, GAAP financial measures. Reconciliations to the most directly comparable GAAP measures can be found in today's earnings press release, which is available on our investor relations website.
Don't sue them.
Hosting today's call are Max Levchin, Affirm's founder and chief executive officer, and Michael Linford, Affirm's chief financial officer. With that, I'd like to turn over the call to Max to begin.
Hello,
All right, Mac.
and thank you
Max.
for joining us on this earnings call. Affirm is just a handful of days away from its 10th anniversary, and this earnings report also marks the first anniversary of our public debut. While the road ahead of us is significantly longer than the one we've traveled so far, the occasion does warrant a moment of reflection on the execution of our strategy during the last 12 months. We feel great about our progress. We remain quite unpivoted and focused on delivering long-term compounding value to all our stakeholders, consumers, merchants, employees, and shareholders. As we introduced ourselves to the public markets a year ago, we talked about several key themes. First and foremost is our mission, which is to deliver honest financial products to improve lives, and to do so while delighting the people we get to serve every day. Because the opportunity embedded in our mission is still so vast and open, consumer growth is very important to Affirm. We've done very well. Indeed, our active consumer growth accelerated, growing by 150% to provide well north of 11 million people with a smarter way to pay. Growth for us is never just about getting the next million consumers. It's also about the impact we can have on the financial well-being of the folks who rely on Affirm. We've also talked about our other all-important constituent, the merchant. Affirm is as much a safe and transparent pay over time option for the buyer as it is the ultimate marketing tool for the seller. We help our partners drive meaningful incremental sales without needing to resort to gimmicks or discounting. The number of active merchants on our platform is another key measure for Affirm, and over the last year, we've significantly expanded our reach. There too, we accelerated with a more than 20x increase from a year ago and a 64% increase from the rolling 12-month tally we reported just 90 days ago. As a company founded by engineers, we focused early on investing heavily in technology, scalable enough to economically support the smallest of businesses all the way up to the world's largest retailers. We've continued this policy of investment and development in pursuit of technological competitive superiority. The strategy is working and delivering results. In fact, our technology is what has enabled us to work with tech-savvy giants such as Walmart, Shopify, Amazon, and Target. We estimate that this year, Affirm processed 1.6% of all U.S. online transaction volume for the Black Friday Cyber Monday period, another triple-digit increase from last year. Simultaneously, a momentous number and a signifier of just how early we are in this market. Even a decade in, the ramp up to the holiday shopping rush is an intense yet exhilarating exercise in scalability preparedness. Each year's Black Friday weekend brings by far the greatest number of concurrent transactions we've ever experienced. I'm very proud of our engineering teams for delivering another flawlessly executed, record-breaking Black Friday weekend. And I'm also grateful to our friends at Shopify Engineering who had lent some of their technical expertise to us as we prepped in the days before. It is an oft-repeated adage that product innovation slows down as companies go public. I'm pleased to report that we were able to accelerate our product delivery since the IPO. We've rolled out cashback rewards for participating merchants, delivered the unique adaptive checkout, launched the Affirm Super App and the Affirm Chrome extension, and introduced the beta version of super simple, consumer-friendly crypto savings. You may have noted the announcement of Visa being the launch partner for Debit Plus, which is now in the initial waitlist rollout. Though I will continue to caution you to not yet get crazy forecasting this product's impact on our P&L at scale, I do have fun insights to share. On average, the number of weekly transactions by a Debit Plus consumer, excluding our own employees, is greater than an order of magnitude above that of a regular Affirm user. Of course, these are enthusiastic early adopters, and we fully expect the number to normalize.
Hit the subscribe button.
It's exciting to see first glimpses of what Affirm as a daily instrument might look like. We remain very excited about the future of this product and expect to talk a lot more about it this year.
Okay.
We had said last year that BNPL is an international phenomenon, and we intend to bring Affirm's unique, no late fees, no gotchas, no regrets approach well beyond our home borders. Over the last 12 months, we've solidified our industry leadership with PayBright by Affirm in Canada and launched in Australia, our first non-North American market. And the growth of our business continues to accelerate. Affirm had more than 168,000 active merchants on the platform as of the end of calendar 2021, largely thanks to our partnerships with online commerce platforms. In aggregate, Affirm is now present on sites that account for more than half of all U.S. e-commerce, and that number continues to march higher every day. In our second quarter, year-over-year GMV growth accelerated to 115% from 84% in the first fiscal quarter. Moving beyond the testing phase of our collaboration with Amazon before the holidays was a significant driver of this growth. However, if you exclude Amazon, our GMV still doubled year over year. We are highly cognizant of the fact that over 80% of commerce is still conducted offline. Our recently announced partnerships with Verifone and Adyen are just two of the numerous investments we're making with our partners to bring honest financial products to consumers at the physical point of sale. We're also expanding the ability to use Affirm in-store with our own products like Debit Plus. Our focus on using exceptional technology to drive growth and improve efficiency has been a winning strategy for Affirm, and we never stop finding ways to optimize and deliver even more value. This shows up in our results in a number of ways, from new partnerships to long-standing relationships. For example, iterating over the last 3 years, our relationship with Walmart has grown as we proved the value of our products. We expect similarly great things from our other major partnerships with time.
Every month, the
As we
strength of
develop
our
with
brand is
and learn from
unmatched.
each customer,
I'm sorry, guys.
we're
Zillow,
excited to
search
bring these
more on
learnings and the products they engender to all merchants, big and small. The strength of our network is measured in merchant coverage and repeat consumer engagement, both of which are rising rapidly. We grew total transactions by 218% and transactions per active user by 15% year over year, even as we added a tremendous number of new consumers. Our momentum is strengthening, our strategy is working, and we are extending our lead. We intend to double down on the 3 key things that got us here. 1, deliver unique and delightful financial products that align fully with our mission. 2, continue to be the partner of choice for merchants that care about intelligent growth, scalability, and reliability. And 3, deepen our underwriting advantage. Speaking of underwriting, we manage risk.
Are you
So
buying
we're
the dip?
an easy-to-understand tool to maximize one's personal capital and the retail marketer's best friend. At our core, Affirm is ultimately a risk-managing business. We facilitate the transaction, settle with the merchant soon thereafter, and bill the buyer over a predetermined period of time. But wait, there's more. When we charge interest, which we don't always do, we don't compound it into principal. Moreover, we don't compound interest after it reaches the amount we communicated to the consumer at purchase time. We refund interest when the buyer prepays. We don't even charge late fees. These are all deliberate choices made in the first few days of our company's life. We meant to align ourselves with our consumers in this manner, avoiding the moral hazard of capitalizing on their mistakes for revenue opportunities. These decisions are as on-mission and moral as they are self-serving. These policies are an important part of why our consumer satisfaction is so high, and we only want it to go up.
AFRM ripping.
With these self-imposed guardrails, exceptional underwriting and risk management frameworks are a requirement. That's why we underwrite every transaction before making a credit decision, unlike some of our competitors in the BNPL space who readily admit they do no underwriting at all. It is also important to understand that unlike many players in our industry, we do not treat delinquencies or defaults as an outcome of our business decisions. Indeed, we choose acceptable delinquency rates as an input into our decision-making based on the pricing our products command with our customers, our view of the macroeconomic conditions, and the demand for our loan volume in the capital markets. This distinction may seem subtle, but I think it really helps understand our approach to risk. We spent the last decade building what we believe to be one of the best-in-class credit underwriting ecosystems. Data, tools, processes, and teams that deliver underwriting models with some of the very best results in the industry. Today, I'll pull the curtain back a little, and while I will keep it very high level, in part to avoid giving out trade secrets, feel free to tune out for a few minutes while I nerd out. Affirm's underwriting advantage begins before any of our models are interrogated for a decision with our product design. Because Affirm is predominantly offered at the point of sale, we have a natural opportunity to explain our value and transparent approach to the consumer. As a result, we avoid much of the adverse selection that often comes with traditional lending. Coupled with SKU level data we receive from our partners, our models tend to split the risk far better than those used in traditional consumer loans. Another fundamental structural advantage Affirm has is its total separability of transactions. Unlike providers of lines of credit, we underwrite transactions individually, modeling a consumer's ability to pay us back as well as their propensity to do so. This notion of separability is also recursive, a consequence of our product. Because repayment schedules are highly predictable, our models operate at an individual installment level. This separability is a powerful tool for modeling as well as managing risk. We're able to deliver a reliable forward-looking picture of both consumers and our own cash flow. Our proprietary network of directly integrated merchants, as well as other sources of non-traditional underwriting data, offers us a significant raw data advantage in feature engineering. We maintain a library of over 500 features that we select from as we create new models or update existing ones, while continuously looking for and eliminating any potential for disparate impact in our decisioning, both at individual variable and model levels. We train our models using academically well-understood gradient boosting technique, with significant proprietary modifications we've invented that help us improve results. Because from the very beginning, we focused equally on consumer and merchant information, we ended up with a large number of models that are specific to our products and merchants who use them. Moreover, as we launch new products with new and existing partners, we acquire new types of data that we incorporate into the models and over time give incremental weight to. Underwriting models decay over time as macroeconomic conditions and consumer behaviors change. Even the very best performing ones can lose a few percentage points of their area under the curve every few months. Over the years, we've built special purpose models that track model decay, the machine learning equivalent of a canary in a coal mine. Our proprietary software and processes allow us to rapidly retrain, retest, and redeploy models where the performance has deteriorated in a matter of days. To illustrate this, let's take a side-by-side look at ITAX, one of our longest-serving proprietary models, versus a traditional credit scoring system like FICO. Using ITAX, reducing originations by 10% would eliminate a third of all delinquencies in dollars, while using the traditional credit scoring system would only reduce delinquencies by a mere 13%. Let's take it a step further. If we were to reduce originations by 30% using ITAX, we would remove 70% of all delinquencies, while the traditional score would only catch 36. So needless to say, this model slopes a lot better than a traditional industry standard. These achievements may sound quite abstract, but they have a very real impact. With our superior underwriting capabilities, Affirm can approve many more college students buying tickets to see family after months of pandemic isolation and young parents picking up their first stroller. And because Affirm's average loan duration at origination by design is very short, at just 5.2 months, the exceptional precision and recall of our credit models give us great confidence that our portfolio, both retained and sold, will continue to perform well in the future. Any use of advanced technology has both advantages and risks associated with it. As we push our model performance further in pursuit of expanding our offerings, we work just as diligently on ensuring that our models are both compliant with all applicable laws and rules, and that our model decisions are both reasonable and are understandable by consumers. We regularly audit our models to avoid correlation with prohibited bases and have them audited externally. We also invest heavily in explainability of model outcomes so that both consumers and regulators can understand our decisions quite easily. None of this, of course, would exist without the extraordinary team of people that make it all possible. I am truly fortunate to have been able to start this company with a group of brilliant minds who in turn attracted more and more talented folks to join our mission and bring their mathematical and other talents to bear. It is this embarrassment of riches among my teammates that makes me so optimistic about the next decade of Affirm. Large as some of these numbers might be, Affirm still accounts for around 1% of US e-commerce, and both consumers and merchants are genuinely excited to get more value from Affirm, and we are excited to deliver it. As usual, I want to thank my team for all their amazing work, and even during some pretty volatile moments for our stock price, for staying truly focused on the long-term value creation for all our stakeholders and on our mission. Now on to Michael for the numbers.
They need to raise whoever made that dude the narrator.
Max,
That
and
dude's
good
got the
afternoon,
goat
everyone.
narrator voice.
Our second quarter results demonstrate a massive step change in our network scale, driven by our partnership with the largest enterprises and our technology advantage. Growth accelerated on both sides of our network, as active consumers more than doubled, while active merchants increased more than 20 times. Frequency increased alongside that explosive user growth, Total transactions grew 218%, the fastest rate since our Series D private funding round. We grew GMV 115% and revenue by 77%. In November, we completed the rollout of our initial offering at Amazon in the United States. And even excluding Amazon's contribution, we significantly exceeded our outlook for both GMV and revenue. Unit economics were also strong.
Subscribe.
Revenue less transaction costs grew faster than revenue at 93% from the prior year. And even as we accelerated network growth, we continued to operate with efficiency, reducing the equity capital we used to fund our loans by 17% versus last year. With the accelerating growth of our business and the early traction with our enterprise partners, we are raising our outlook for fiscal year 22, which I'll share more about in a moment.
So they're raising their
Before
outlook.
I do that, let's walk through the second quarter results. Unless stated otherwise, all comparisons refer to our second fiscal quarter of 2022 versus Q2 of fiscal 21. We had another great quarter for consumer growth. Active consumers increased 150% to 11.2 million and increased 2.5 million sequentially from fiscal Q1. Despite adding users at this aggressive pace, we grew transactions per active consumer by 15% year to year and more than tripled the number of transactions. More merchants, platforms, and brands are leveraging the power of Affirm to grow their businesses. In the second quarter, active merchants grew to more than 168,000 from just 8,000 last year, thanks in large part to the scaling of our partnership with Shopify.
Yep.
On a sequential basis, active merchants, which we calculate over a trailing 12-month timeframe, grew 64% from the September ending quarter. Turning to GMV, we grew GMV to $4.5 billion in our second quarter, a $2.4 billion increase from last year. The 115% increase includes the volume from our partnership with Amazon. We completed the launch of our interest-bearing program at Amazon in November, ahead of Black Friday. And while the program is still in its infancy, with a long roadmap of optimizations to work on, we have seen rapid consumer adoption. We look forward to years of growth from this collaboration. We have strong momentum across our business. Excluding Amazon, GMV doubled, with growth across all products and verticals. I would also note that our business with Peloton, our second largest merchant partner by GMV in the quarter, was up against an unusually strong prior year comp following the launch of a new product slate and boosted by COVID tailwinds. As a testament to the increasing depth and breadth of our network, no single merchant accounted for more than 10% of Q2 GMV. 1 year ago, we discussed how we would expand into higher frequency purchase areas and diversify our merchant partnerships. A year later, I'm really proud of how our team has delivered on these objectives for our shareholders. Shifting to industry vertical, we had a phenomenal holiday season. We more than doubled our volume for Black Friday, Cyber Monday, and we believe we took significant market share from both traditional incumbents and BNPL pure plays. As Max shared, we estimate that Affirm facilitated 1.6% of total online transaction volume for the Black Friday, Cyber Monday period in the US, and we saw particular strength in key holiday categories in Q2. Travel and ticketing increased up 314% from last year, topping last quarter's high mark, even despite the emergence of the Omicron variant. General merchandise grew 368% above last year, driven by our deepening partnership with the industry's leading retailers and the launch of our offering at Amazon in the US. Consumer electronics, which grew 209% year to year, was another great story driven by strong demand for TVs, laptops, and gaming consoles. Our results this holiday season highlight our ability to take share and grow in any environment, and importantly, why we're so different from the competition. Outside the US, we had another outstanding quarter. Our Canadian business more than tripled in size, thanks to existing and new partnerships, including Apple, which launched in the fall to brisk consumer demand. In the second quarter, we also entered the Australian market with Peloton and look forward to growing our business with them there. This quarter, our interest-bearing program, which includes our initial offering at Amazon, grew significantly, up 124% year on year to $1.4 billion. Before I jump into the financials, let me walk through the mechanics of this offering to illustrate the impact on the income statement. On the revenue side, we monetize these loans by either holding them to maturity or selling them to third parties. When we hold the loans, we primarily earn interest income, which we recognize over the duration of the loan. Hence, this quarter's revenue reflects just a portion of the total yield we will ultimately see from the GMV we generated in Q2. We will recognize the balance over the subsequent quarters. As an illustrative data point, we sold 59% of the interest-bearing loans generated in the U.S. this quarter and retained the remainder. On the expense side, we provision for credit losses up front. For loans we hold, this means that the margin profile is back-end weighted. Our partnerships with key enterprise merchants are unlocking more opportunities for our business every day, and we are investing today to realize the full long-term potential. While we are just in the beginning stages in scaling these partnerships, we are already seeing them drive network expansion, and we expect to deliver strong unit economics when they reach scale. Now, turning to the financials. The strong GMV growth also drove strong revenue growth. Net revenue grew 77% to $361 million, well above our outlook. Total network revenue grew 39%, while interest income increased 87%, and gain on loan sale rose fourfold. Revenue as a percentage of GMV contracted 170 basis points to 8%, driven by product mix. Split pay grew over 4 times year on year and accounted for more than 20% of GMV.
This is a pre-recording.
11% last year. In our earnings supplement posted to our investor relations website, you will see that merchant revenue take rates have remained relatively constant for each of our offerings. On the expense side, we continue to grow revenue faster than transaction costs, delivering real leverage. Total transaction costs of $177 million grew 63% year over year compared to revenue growth of 77%. And excluding provision for credit losses, transaction costs as a percentage of GMV declined 190 basis points to 2.8%. Given the mix shift from longer duration 0% APR loans, loss on loan purchase commitments declined 4%, while improvements in our capital program helped limit the growth of funding costs to 47%. Provision for credit losses grew from $13 million 1 year ago to $53 million, as the year ago figure included a $39 million release of excess COVID-related loan allowance, while this year's figure reflects the intentional normalization of credit that we've discussed over the past several quarters. Over the first half of the fiscal year, we have managed delinquencies of 30 days or more to remain below the same periods of fiscal 2019 and 2020, even as we have expanded the credit box to a more normalized level compared to the early days of the pandemic. Our strong top-line growth and leverage we achieved on transaction costs drove a 93% increase in revenue less transaction costs to $184 million, above our outlook range, or 4.1% of GMV. Looking at OpEx beyond transaction costs, we continue to invest in building our team and elevating our brand. We doubled headcount to more than 2,000 firmers and increased marketing around the holidays. Our teams have delivered a torrent of exciting new offerings, while our brand campaign drove greater awareness across all age cohorts and helped us reach the highest aided awareness among BNPL providers at 45%. Growing our team resulted in higher personnel costs and stock-based compensation. In Q2, total operating expenses, exclusive of transaction costs, grew $258 million, of which $158 million was related to D&A, stock-based compensation, warrant expense, and one-time expenses related to our IPO and acquisitions. Excluding these items, non-transactional operating expenses grew 109%. On a GAAP basis, operating loss was $196 million, which compares to a loss of $27 million last year. Adjusted operating loss was $8 million in the quarter compared to a $3 million of income in the prior year. Now turning to our balance sheet. We fortified our cash position and delivered accelerating GMV growth while continuing to manage our capital with discipline and efficiency. In November, we issued $1.7 billion in zero coupon senior convertible notes with a 5-year maturity, which has significantly increased the capital we have to invest in growth at an extremely attractive long-term borrowing cost while minimizing dilution. Our effective capital markets program and disciplined approach helped reduce equity capital used to fund our business from $277 million last year to $230 million, even as loans on the balance sheet grew by more than $500 million. As a percentage of total platform portfolio, equity capital required declined to 3.6% from 7.5% last year. Total platform portfolio grew 72% from $3.7 billion to $6.3 billion at the end of Q2, and we increased our overall funding capacity in line from $4.7 billion last year to $8.8 billion. Over the past year, we brought on $1.9 billion in new loan buyer commitments from both new and existing capital partners. Our balances held by third-party loan buyers from our forward flow program grew 129% to $3.7 billion, while our securitization program grew 83%. Our warehouse balances declined 24% as we continue to focus on more efficient funding vehicles. Before I move to our outlook, I want to touch on an important topic that has been top of mind for investors: interest rates. While potential interest rate hikes have dominated headlines, we remain confident in our ability to continue to grow rapidly while delivering strong economics as rates rise. Our financial outlook already reflects the roughly 180 basis point increase embedded in the 3-month LIBOR forward curve, and our current long-term model, which calls for revenue less transaction costs of 3 to 4%, also assumes rate normalization. We have significant advantages to help us mitigate the impact of rising rates, including broad and diverse funding partnerships that allow us to shift funding to less rate-sensitive counterparties, sophisticated underwriting and risk management infrastructure that allows us to manage unit economics with changes to our cost environment, and high turnover, short-term assets that make our portfolio inherently nimble and able to react quickly to changing market conditions. At a constant product and funding mix, we estimate that a 100 basis point increase beyond the increase implied by the current yield curve would only result in a 10 to 20 basis point impact to revenue less transaction costs as a percentage of GMV for the remainder of fiscal year 22. Looking out to fiscal 23, we believe that a further 100 basis point rate increase, again, beyond current expectations, would only result in approximately 20 basis point impact to revenue less transaction costs as a percentage of GMV based upon our current funding and GMV mix. And that is before we apply any of the numerous offsets we have, including consumer and merchant pricing, funding strategies, and credit optimizations. Looking beyond fiscal year 23, at our current funding and product mix, we estimate the impact to revenue less transaction costs as a percentage of GMV to be approximately 40 basis points for every 100 basis points of rate movement beyond the current forward curve. And again, as before applying any cost, credit, and revenue optimizations. Now, turning to the outlook. Our business has never been stronger, and as we look to the remainder of our fiscal year, we are raising our financial outlook to reflect the robust second quarter results, accelerating momentum in the business, and we are now including Amazon's expected contribution to the outlook. For fiscal year 22, we now expect GMV to be between $14.58 and $14.78 billion, representing a 76 to 78% increase from fiscal year 21. Given the strong traction we are seeing with Shopify, we now expect our split pay offering to comprise 15 to 20% of total GMV for the fiscal year. We expect revenue of $1.29 to $1.31 billion, representing year-over-year growth of 48 to 50%.
Okay.
We expect transaction costs of $705 to $715 million, resulting in revenue less transaction costs of $585 to $595 million. This reflects the continued mix shift we are seeing in the business. We expect an adjusted operating loss as a percentage of total revenue of 12 to 14% as we continue to invest in the long-term growth of our business, and weighted average shares of approximately 285 million. Consistent with Max's remarks, our outlook does not assume a material impact from the rollout of Debit+. We also expect a very strong fiscal third quarter with GMV of $3.61 to $3.71 billion, total revenue of $325 to $335 million, transaction costs of $187 to $192 million, and revenue less transaction costs of $138 to $143 million. Adjusted operating loss as a percentage of revenue of 19 to 21%, and weighted average shares outstanding of 290 million. In closing, we just posted an incredible quarter of growth, and our team is seizing this momentum to continue to deliver on our mission.
Okay.
I'd like to add my thanks to the great work of all Affirmers this quarter. Max and I will now open the line for questions.
All right, so this is the good part. Will they ask about the leak? Let me know what you think in chat.
Ladies and gentlemen, at this time, we will be conducting a question and answer session.
About the leak. They didn't say anything about
If you'd like to ask a question, you may press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue.
I'll ask them about the leak.
You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. One moment while we poll for questions.
Before we open it up for Q&A, I want to briefly address the earlier than customary issuance of our earnings press release today. Due to human error, a small portion of our Q2 results were inadvertently tweeted from Affirm's official Twitter account earlier today. And because of that, we felt it was appropriate to release our full financial results as promptly as possible thereafter, rather than waiting until after the market closed. With that, I'll turn it over to
Somebody
Doug
got fired.
the Q&A session.
Social media posted on Twitter, I believe it was.
Thank
Twitter.
you. Our first question comes from the line of James Fawcett with Morgan Stanley. Please proceed with your question.
Great. Thank you very much. I guess my first question is, obviously, the December quarter was massive for you guys, but the outlook doesn't seem as comparatively strong, especially the March quarter, and particularly if we're now incorporating more split pay from Shopify and Amazon, et cetera. Can you walk us through kind of that dynamic, especially on a sequential basis? I mean, is this seasonality, more than expected drag from Peloton, impact of revenue timing on Amazon and others? Just kind of help us understand the sequential evolution of the business.
Yeah, I'll grab that one. And I think to start off, we're very happy with the pace of scaling in the network.
They're not big.
The Q4 results, as you said, were pretty spectacular. Sorry, calendar Q4 results were pretty spectacular, and it was indeed a special quarter. We are reiterating our guidance and taking it up, so our outlook continues to improve for the balance of the fiscal year, and we're still well in excess of the growth phase. We're in the hyper growth phase for the stock, and so we feel really good about the scaling that we're doing. Yes, there are impacts of seasonality. Calendar Q4 tends to be heavier with holiday shopping, and as I shared in my remarks, we had a really strong holiday season, so there's a little bit of sequential impact there. And yes, the growth of interest bearing will tend to create some back-endedness to both the revenue and margin profile of those originations. But again, I think we're very happy with the pace at which we're scaling, and we're certainly not focused on or concerned with the next quarter. We're really looking about where this network will be over the next decade.
Posted the Affirm leak, like what it was
And
in my
then,
Discord.
Michael,
I'll post the
this
Discord
is
right
probably
here.
also for you, but and I think both of you and Max highlighted that there's been a lot of questions around interest rates, but a lot of the other questions have to do with delinquencies, et cetera, and as you said, is that you're kind of close to your target. But we noticed that the most recent update, at least in the supplemental, indicated that the percentage of 30-day delinquencies started to turn down and away from kind of your 2% target in recent weeks. Is that purely because of the nature of the incremental mix from the likes of Amazon, or better consumer repayments, or are you tightening the credit standards? And how should we expect that to evolve in coming quarters?
Yeah, very good question. If you look at the chart that we have in the supplement, you can see the seasonality curve of delinquencies. There's actually quite a bit of seasonality tied to both the shopping seasons and the repayment schedules that happen, and we're back to a more normalized seasonality curve with respect to what you see in delinquencies. And to reiterate the point, I mean, we're very happy with the credit outcomes we're driving right now. We take a very intentional approach here, and we have intentionally been loosening the credit box over the past year. We're still below 19 and 20 numbers, fiscal 19 and 20, and feel really good about the level of delinquency in light of the total unit economics that we're driving. And the only other thing I'd add is that we really do manage to a total portfolio number here. There's a bit of a misunderstanding, we think, out there with folks looking at not the portfolio delinquencies, but looking at one securitization vehicle or one particular slice of our business. We are very thoughtful about portfolio construction that goes into any one of our funding vehicles, and each one has a unique profile based upon market demand and our needs. For example, the split pay content may change. We may pledge loans that have some starting delinquency, et cetera. And so no one securitization data set can really represent the portfolio, and would really encourage everybody to look at our investor supplement to see a real view of portfolio-wide DQs.
That's great, Michael. Thank you very much.
Subscribe for all major earnings calls streamed live here. Subscribe now. Do it now.
Our next question comes from the line of Timothy Chiodo with Credit Suisse. Please proceed with your question.
Great. Thanks for taking the question. Michael, you touched on this a little bit in your prepared remarks in terms of slide 13, which has the merchant fee rates. And you're right, overall, most of the lines are pretty stable. I wanted to see if we could just touch on a few of them that are moving around a little bit. Specifically, the dark blue, which is the split pay, seems to be ticking up a little bit in terms of the take rate. I was thinking maybe that could be related to Shopify. Also, the purple line, which is the core IB, just ticking down a hair, maybe related to Amazon. And then if you could help us maybe elaborate on either of those, and also the green, the non-integrated virtual card, I'd really appreciate that context.
What?
Yeah, the last we have the least amount of control over. That really is a function of the network interchange.
Drop
that
on
we
the latest
earn.
candle.
And I think you nailed it. The line that you see on split pay merchant fee rates up versus Q1. We were promotional with Shopify in particular in Q1, but really up even year on year back to the fiscal Q2 in 21. So we feel really good about our resiliency with respect to the most competitive space, which is the split pay product set. The IB line that you point out is a function of the growth that we have in our largest enterprises, where we would earn less there than we would everywhere else. And part of the reason we're so confident in how we're growing is those two things mix in our favor, where you've got a lot of growth in the split pay offering with really high merchant fees, and you have a lot of user growth that comes along with that, combined with these enterprise scale offerings that will drive tremendous processing volume, as well as in the long run, we think really strong economics. So feel really good about the mix. I really want investors to understand that, when you have this sort of major shifts in the mix in the portfolio, it will shake out differently in the income statement.
I'm going to add the previous closing price
well taken
to
there on the
to
various
this
mix dynamics.
chart so you
Appreciate
can
it.
see where it
Quick
closed.
follow-up is on processing costs. So fully appreciate that the Shopify revenue share will hit in that line item, which could cause a little bit of upward pressure on that specific expense line. But a potential offset could be reduced card mix within their loan repayment. Is there any potential for you to work with someone like a Plaid or a Finicity to help increase the mix of direct bank account repayment?
Yes, there is the potential. I was just starting to fall asleep because you guys are asking Michael excellent questions, and he's doing a great job of answering them. Sorry. The long and short of it is,
what?
It's exactly right. The way I think, and this goes back many years now, the way we look at our transactional economics is across multiple dimensions. One is, of course, lifetime value of the consumer, kind of managing credit side of it. But if you, in the ROA basis, you have to look at the charge-offs that you incur, and once Michael touched on this really well, and it's kind of all over my script, but basically we manage that to a number. We decide what that's going to be, and we drive that to a basis point that we like per product, per merchant, etc. After you're done with that, you look at your other costs, and servicing is the one where we're always really hesitant to mess too much because you want the consumer experience to be amazing. And obviously over time we'll optimize that to a perfect number, but the sort of the high touch white glove service that we've created is really, really valuable to us. We're completely ruthless on the rest of it. The repayment cost is something that just screams, take these basis points away. And you're totally right. There's lots and lots of opportunity. The repayment devices or vehicles are not all created equal. There's some really interesting innovation happening even sort of beyond ACH, which is currently kind of the most popular / cheapest one. And so we will absolutely do lots of things there. It is more important, and in this whole story of this quarter, we're reporting and going forward, but we're still taking enormous amounts of white space. The growth of the network is what we are grading ourselves on right now. We are paying attention to costs, and at scale, these are real dollars, and we'll invest in reduction of these costs as well. And you guessed pretty well where opportunities are.
Excellent. Thank you, Michael and Max.
Ask about the leak. Ask about
Our
the
next
leak.
question comes from the line of Ramsey El-Azael with Barclays. Please proceed with your question.
Hi, guys. Thank you so much for taking my question this evening. I wanted to ask about the spread between volumes and revenue less transaction costs, and just kind of get your expectations about where those kind of yields should sort of trend and shake out over the next few quarters. Where do they exit the year? What should we think about in terms of next year modeling them out? If you could comment on that, it'd be very helpful.
Yeah, we're not ready to give guidance for 23, so avoid that one. But I think the guide that you see in the results we just posted, we talk a lot about the long-term economics of the business being somewhere between 3 and 4% on a revenue less transaction cost basis. And we're on the higher end of that last quarter and inside the guidance for the back half of the year as well. While, I think it is changing quite quickly with respect to the product level economics. If you're taking on a split pay product with 5 to 5.5% merchant fees, you're not going to be making 4 points of margin. And so you do expect a little bit of compression on a percentage of GMV basis on the split pay business. And yet the opposite is true on our interest-bearing business, where we're able to earn even higher total revenue less transaction costs, but over time. And I think as we continue to scale some of our enterprise partnerships, you're going to see some, again, back-endedness to the timing of those things. So our guidance reflects the mix that we expect over the next 6 months. And we'll update everybody with 23 back when we talk later this year. But we're not at all concerned with our long-term guidance of staying in the 3 to 4% range, which we believe is still materially better than our competition.
Okay. And I guess more broadly on profitability, can you kind of give us your updated view on the sort of longer term multi-year path to profitability? Has ramping up any of these larger, significantly larger partners like the Amazons of the world, maybe faster than expected, the ramp down of Peloton, has there been any change to your view or approach or ability to kind of solve for profitability at the same pace over the longer term?
No, I mean, Max's line in the setup today is one I'd like to reiterate, which is our strategy hasn't changed. We talked about the financial model and framework in September, and that remains true no matter the macro conditions changing. While we have the opportunity to grow at this pace with what we think are industry-leading unit economics, we're not going to take our foot off the gas, and we're going to keep scaling up the network. And the path towards profitability, the long-term financial profile of the business remains the same, and it is a function of us achieving scale greater than where we're adding human capital. That human capital is what's driving all of these, we think, fantastic results, and we're still well prepared to keep investing into what we think is an incredible growth opportunity.
Great.
Okay.
I appreciate it. Thanks.
Affirm testing the previous closing price right now.
One more way of thinking about it that I guess
ask about the
I
leak.
utilize fundamentally, just from going back to my experience 20 odd years ago, pricing power of a payments network is directly proportionate to the number of active users it has. Full stop. Like ultimately, when you come to marketing, say, I have a product and I would like you to buy my way of delivering tender, the price that product is able to command is inevitably a function of how many people are using that product, prefer it, would like to use that at checkout, whatever way you want to call it. And so the reason we are so consumer growth and coverage obsessed isn't for some sort of a vanity number, but the fact that ultimately we intend to come to market and say, we are the largest network, we are the most active network, we would like you to pay for that appropriately. And so this growth is a direct tie to the path to profitability.
I see. Great. So not too much has changed since your prior view, despite how the business has evolved. I appreciate it. Thanks for your answers.
Bullish or bearish on Affirm? Let us know in chat right now.
Our next question comes from the line of Dan Perlin with RBC Capital Markets. Please proceed with your question.
Thanks, and good evening, guys. I wanted to ask a question around the kind of frequency of repeat customers versus the first-time users. You have a slide on that a little bit. And the question is really, the interplay there between your customer acquisition model and how we should be thinking about, that influencing cost into the second half of the year and maybe even, into next year.
Yeah. So
did you fall asleep again?
Go.
I'll start and then Max can add on. I mean, I think we included that slide in the supplement because we're really proud of what's going on underneath the surface. So we have a step change in the number of users, 150% growth, and increasing frequency when you have that much user growth is actually really challenging. And if you look at that chart and look at just the total transactions from repeat users and the growth there alongside the net new user growth, it is which I feel like a really good spot for the business. There is some impact with respect to the rate of new user growth on unit economics. First time use tends to be slightly less profitable than the lifetime value of the consumer. And so you do have a little bit of startup costs associated with that user growth. But as Max mentioned before, long term, that's much more important to us. So we're going to keep adding users at a very aggressive clip. We're going to stay focused on that. And part of the reason we have so much confidence in the long-term economics is that's happening right alongside tremendous growth in repeat usage on the platform. And we talk about network effects in the business. That's what that means. And in the long run, it gives us all the confidence in the world around where the economics will ultimately be.
Yeah. No, I thought that was a pretty impressive set of numbers as you think about growing the network that quickly, to have that level of frequency so quickly. So the other question I have, do you have any insight that you could share with us around kind of January trends in particular, around the health of maybe some of the lower income cohorts that might be coming into the portfolio? I know some players out there have some concerns around what that dynamic is looking like. So if you could share any of those, that would be great. Thank you.
Yeah, I think what you saw in the disclosure around the delinquency trend is similar to I think you should think about it, which is to date, our credit outcomes are still a function of the decisions we've taken with respect to approval rates. There's obviously any number of seasonal effects that do require taking a fine-tooth comb over, but not seeing the broader weakness that others have seen in our overall credit performance, and feel really good about where we're at, and that's what gives us, again, the confidence to give the guide that we have for this quarter.
Great, thank you.
All right, so I don't think they're going to let anybody ask about the leak. I think they're just going to.
Our next question comes from the line of Jason,
but we'll see.
Kopferberg with Bank of America. Please proceed with your question.
Hey, thanks, guys. So I just wanted to come back to this kind of general topic of, we're adding $1.5 billion of GMV to the full year guide, but we're basically not changing revenue less transaction expense. I know you're talking about the interest-bearing loans and kind of the revenue recognition dynamics there. I mean, how long is that lag typically? I mean, I think this is a dynamic that's kind of throwing people off a bit, and how much of this sort of dynamic is due to Amazon?
Yeah, so the Amazon's part of it, but while the growth rate in Amazon, the addition of Amazon is great for us, as we communicated, we still doubled GMV excluding Amazon, and so we know there's a lot of growth happening across the whole portfolio. So it's not just limited to Amazon, but the interest-bearing portfolio is growing quite quickly, and that does tend to have that effect that you talked about. The other obvious impact with respect to the revenue less transaction cost as a percentage of GMV is the mix towards split pay, again, as it does run lower. I mean, again, it's a repeated theme with us, but product mix really does shake out with respect to the take rates on both revenue and the revenue less transaction costs. And again, I think the only other thing to repeat is we feel like we're operating at the higher end of the range that we've given folks in that 3 to 4% range, and have a lot of confidence, again, in our long-term unit economics here, and again, would put ourselves up against anybody in our space with respect to the rates at which we're delivering here.
Okay. And then I guess just for the back half of the year, how should we be thinking about GMV growth excluding Peloton? Like has your full year expectation on Peloton changed at all, just given some of the challenges that they're having?
Our current guidance reflects all of our current thinking on where they're at. We had, frankly, a good quarter in Q2, above our internal expectations, and feel like they're still delivering
an incredible amount of volume for us. And, we admire their brand and we admire the loyalty that they have amongst their consumers, and we'll keep partnering with them. We launched with them in Australia this past quarter, and we're going to keep helping them grow their business.
Yeah, for sure, Alex. Just a young company.
Okay.
Guys
Thank you.
sleeping, earnings leaked. Maybe they'll get better with time. I don't know.
Our next question comes from the line of Andrew Jeffrey with Truist Securities. Please proceed with your question.
I think they need to let somebody ask about the leak as well.
Hi, guys. Appreciate you taking the question. Maybe as it relates to Shopify, I'm still trying to sort of reconcile James's question a little bit too. I think you said it'll be 15 to 20% split pay. It will be about 15 to 20% of GMV this year. I guess the first question would be, where do you think that can go? It's a pretty quick ramp, although not totally out of line with our expectations. And then the follow-up would be, it kind of implies, based on your guidance, that the rest of the business is growing about 45% volume-wise, which might be a little bit lower than we might have thought. Can you just address those 2 points?
I'll start and I'll let Michael finish. And so I don't think we'll break out exactly what percentage of Shopify split pay installments is, but it's obviously grown really well. The merchant adoption has been excellent, and yet there's no shortage of demand. And so I'm confident it can go up more. I don't think we're breaking that out in our guidance, although Michael can correct me if I'm wrong here. But there's an enormous amount of road there. Just if you take a quick look at Shop Pay, shopping installments doesn't even support interest-bearing loans today. But that alone as a headline should give you a pretty good idea that the service has been scratched, but not a whole lot more.
Okay.
Yeah, and so 15 to 20 is a good number. How big could it be? It could be very big. Just like we haven't launched interest bearing on Shopify, we haven't launched split pay with either of our 2 largest enterprise merchants. So I have a lot of confidence that that number can continue to go up. I think the only other point with respect to the rest of the portfolio growth is just, we are up against continued elevated levels in our call it a long-term zero finance business, and we would continue to expect some of that to be a drag on the balance of the portfolio, but not something that we're trying to again target a Q3 growth number. We're thinking about how this network scales and then how that those network effects show up with repeat usage across the whole portfolio.
Okay. All right. Well, I appreciate it. Thank you.
Our next question comes from the line of Andrew Botch with SMBC Nikko Securities America. Please proceed with your question.
Dropping in the last 5 minutes.
I wanted to ask a question about the CFPB look at buy now, pay later. And from whatever you can share, is there anything you've garnered from those initial discussions that kind of give us a sense of how they're looking at the offering going forward?
First of all, it's obviously not for us to comment on their work there. The thing that's been true for us for the last 10 years is that we have a very, very high moral ground approach to this entire business, to the way we conduct ourselves, to the way we treat consumers, the way we deal with disputes, et cetera, et cetera. And so all things kept equal, we've been at the forefront of the industry suggesting to the regulators that they should have a look and a set of clear rules and just a good guidance around the conduct of all the players. And so in that sense, it's a positive news. That said, it's a regulatory relationship is both a very, very important thing, it's a very serious thing. We're interacting with them. There's a fairly detailed request for information. Obviously, we'll reply to that. But all things kept equal, I think regulatory attention to the space is great. I was a little bit glib when I pointed out that in a public record of the information demand, there was a sort of quite a lot of space dedicated to asking for the information around fees charged, be it late fees or deferred interest or all sorts of other things. And we filled that out with zeros because we don't charge any of those things to consumers. And, took a small amount of pride in that we stuck to our mission and stuck to our approach to treating consumers right. That said, I'm confident over time there will be more regulatory attention and we will comply with all the necessary rules and we'll do well there. So too early to tell what the future looks like. It's certainly for them to determine, but we're very happy to engage.
Helpful. Thank you. Like my follow-up
dropping
would
in after hours.
Is there any kind of guideposts that you can kind of give us from a macro perspective, what you're embedding in the outlook for be it unemployment, inflation, or in rates? And I appreciate the color on the interest rate moves to the impact of the model, but just kind of thinking about what a baseline number that you're embedding in your assumption would be.
Yeah. So again, go ahead.
Sorry, I'll this time I get to take the victory lap. The last one was yours, but so, and I'm sure you'll have macro views as well. But just the thing that I think people really misunderstand about our product, maybe because it is more popular outside of high finance, perhaps. When the interest rates go up, when the prices go up, when prices go up, our product is more useful. If you're trying to make ends meet and you're trying to pay for a couch and your credit card is confusing you and the rates just went up and Affirm gives you clarity and a way to pay for things and a clear schedule, and then you're done and there are no late fees. And half the time, plus or minus, the seller will sponsor it and you pay no interest. Just here's a basic thought experiment. If the card rate that you paid went up 5%, for example, how do you feel about the 0% rate that a seller at a homeware shop is offering you, powered by Affirm? Like, it's 5% more compelling. And so as inflation happens, the product that we provide is actually more powerful, more useful, has significantly better bearing on the sort of consumer demand side of things.
So inflation
on the flip
is
side,
good
of course,
for
the government
Affirm.
addresses inflation, raises rates, etc. I'll stop now, and Michael can tell you what we've done about it. But all things kept equal, at the top line, this is generally a tailwind, not a headwind.
Got it. I appreciate that, guys.
Yeah, just
Michael.
For the total avoidance of doubt, all of our outlook reflects the forward curve. And so there's roughly 180 basis points of rate increases. We take that into all of our models when we give guidance. It's consistent with the market expectation of rate movement. And so we talk about rising rates. That's not a problem for us at all. That's already reflected in the guidance.
Okay.
Appreciate the color.
He might have just been joking when he said he was sleeping.
Question comes from the line of Brian Keene with Deutsche Bank. Please proceed with your question.
Hi, guys. Thanks for taking the questions. Just two clarifications, I guess, just because it's come up a few times. But the implied revenue transaction cost take rate, when you gave guidance for Q2, was almost about 5%. And so I think one of the surprises was it came in at 4.1. And you talked about mix. So is that just that you didn't realize that the shop pay business was going to grow that much and it had that much of a factor on it? Just trying to make sure that the guidance versus the actual.
Yeah, that's right. The mix impact of the business, the growth that we saw, which was obviously well in excess of the guidance that we had given in the quarter, tended to mix towards either lower revenue less transaction costs take rates as a percentage of the total, or tend to be a little bit more back-end weighted. And both those two effects caused the percent to go down, despite the fact that we did, of course, beat the guidance on a dollar basis.
Got it. And then the follow-up question we get often is the profitability on those larger contracts like an Amazon or Shop Pay. You know, how do we think about that? Because those obviously those terms are, you know, with some larger merchants, you know, typically in merchant acquiring, the larger merchants push pricing the hardest. And so, you know, it really all pricing is made on SMB. So just trying to think about that relationship. Thanks so much.
Yeah, if you look at the merchant take rate slide again in the supplement, you'll see that we're doing quite well on the split pay business with respect to our ability to continue to earn good fees. We're not breaking out profitability by partner, but I think a key part of the reason we were able to deliver these exceptional enterprise experiences to the largest merchants is the fact that we're not just reliant on merchant fees. The fact that we do have consumer interest in the economic model does allow us to get to the merchant fee clearing rates that work for largest enterprises while still delivering really strong unit economics.
Got it. Thanks for the clarifications.
Okay. So
our next question comes from the line of Dan Dodd with Mizuho. Please proceed with your question.
Hey, thank you for taking my questions. I just have a question regarding kind of where you are in terms of GMV and what's implied in the guidance. I'm still trying to get my head around, the massive beat in the quarter, and then you seem to be guiding kind of, in terms of a sequential basis, so much lower GMV. I just want to make sure that this is hopefully a sign of conservatism, and that there's the question we're getting a lot from investors this evening is that there's, maybe something else that got weaker. So we just want to reassure ourselves and investors that this is simply being conservative given the strong results. And thank you very much for this.
First of all, I think Michael already mentioned this. Seasonality is a significant component of this business, and so that's an important piece of the puzzle. I'm not sure exactly what you're asking about in terms of something that may have gotten weaker. Not from our point of view. I think we've done fine, and
this guy's nervous.
Not anticipating weakness. But we try to make sure that we promise and deliver, as opposed to promise and hold our breath and see what happens. That's probably a philosophical approach to guidance that we're out there.
Got it. Yeah, sorry, I didn't mean to sort of harp on it. If I look at sort of pre-COVID kind of trends on a GMV basis, it doesn't look like, at least Q3, Q4 weaker. That's why I asked the question. But
in all honesty, the quarter we just exited just an
green or red tomorrow.
So no matter what you sort of say for the next one, it'll look like, well, gosh, what happened here? But our transaction volume, I'm going from memory here, so I may be wrong, Michael, correct me, but I think we tripled year on year our Black Friday Cyber Monday transaction count. We haven't tripled any metric of that class since we were a Series B or Series C company. So the growth of GMV and transactions accelerated quite a lot. We'll digest it and grow some more.
Appreciate it. Thank you so much, guys. Appreciate it.
All right, guys. So I'm going to go ahead and close it down. I don't think they're going to ask about the leak. I'm assuming they're probably screening for the leak. So let me know if you're bullish or bearish on this one. You can vote on the poll after the earnings leak. Are you bullish or bearish on AFRM? You could also join our Discord if you want to see what the leak looked like. If you join our Discord and go to the main chat section of our Discord, you'll be able to see what the leak actually looks like. So, again, we're going to be day trading live on stream for free. We day trade, we invest, we swing trade completely live every weekday morning for free right here on YouTube. So if it's your first time here, I know there's a lot of new people. Hit the subscribe button, hit the notification bell. We cover everything stock market related, basically CPI numbers, earnings, news. We day trade, swing trade, invest, all live on stream. We trade futures, we trade options. We do a little bit of everything here. So if you haven't already, hit the subscribe button. I appreciate you all joining the stream. And yeah, we'll be back. I think we got some earnings next week. If you got any earnings calls you want me to stream tomorrow maybe or next week, let me know. I know we've got like Under Armour tomorrow morning. I know we have next week on Monday, we have a few different places. We got like Alkaline Water, Alexander's, we've got CRISPR Therapeutics, we've got EDSA, we've got EXSR Exchange Bank, we've got Compass Minerals, we got Brooksdale, we've got Seaboard, we've got Ottertail, Cedar Realty Trust, Treehouse Foods, Fang. We have, what else do we have? I'm trying to look at other major names. SNOA, Sonoma Pharmaceuticals, is aftermarket close on Monday as well. IBIO Incorporated. So we got a lot of earnings calls that are coming up. So just let me know if you want any specific that you want us to live stream, again, hit the subscribe button, hit the notification bell. I certainly appreciate you guys being here. Hit the notification bell. Good luck in the market, guys. Let me know if you're red, green, or what on AFRM. I see there's some debates on bullish or bearishness in the chat. So, hey, appreciate you guys being here, even if you're arguing with each other. And yeah, we'll see you guys tomorrow morning, bright and early at like 7 a.m., 6:30, 7 a.m. So later, guys. Good luck. When's in NVIDIA? Let me look at NVIDIA for you, Todd. I got you, man. Let me look it up real quick and see what when NVIDIA is. But yeah, we're going to cover it regardless, no matter what. Okay, so NVIDIA is going to be next Wednesday, and it's going to be after market close. So we will certainly be streaming that. So we'll definitely be streaming NVIDIA. And so again, you want to catch all the major earnings releases and earnings streams and earning calls, hit the subscribe button. Good luck. UPST is Tuesday, so we can cover that one as well. Just hit the subscribe button and remind me, guys. Remind me if I miss it. But NVIDIA, UPST, I'm going to kind of save those. And yeah, good luck. We'll see you guys tomorrow. Hit the subscribe button. If you hit the notification bell, you'll get an alert anytime we go live, which is every morning and afternoon. And so again, hit the subscribe button. Good luck. We'll see you guys yeah, tomorrow. Later, Peridot. Later, Hernan, Todd, Morg, Joshua, Waj. Lucky. Yeah, I saw Lucky say that she was going to be on, or he was going to be on Kramer. So, hey, good luck. I hope that went well. I'm assuming you just called in for a question, but that's cool, man. That's dope. DS, thank you, brother Brooks, Misa, Denny, Ali B, Michael. Yeah, let me know what you think of all of these. David. But yeah, good luck, guys. See you guys tomorrow.